So this year was the third Oxford Real Estate Conference, and each year the conference seems to develop a unique flavour, which is looking at strategic change in the real estate industry. And we've always had a lot of entrepreneurs at the conference, quite a few tech startups. We usually have debates about changing operational and occupational models of real estate, so we're always fascinated by co-working, co-living, and the changes that are going on in the real estate market, often driven by technology, but also through demographic change and politics. And this year, the theme of the conference was overtly managing change, and we had three particular themes that we addressed, and these were politics, demographics, and technology. The two keynote speakers at the conference, Hiram Samel from Side Business School, talked about politics, and Yolandas Model from Savills led us on the demographic issue. And then there were several panels which touched on the various impacts of technology on the property market. And I'll talk about that in more detail because we're just finishing up our first real estate research report at Side Business School, which is on prop tech or real estate tech. And I'll talk to you about that in advance of the report being released in May. So these three topics, politics, demographics, technology, if we look at the first one, Hiram made the point that we're going through a reversion to mercantilism, the end of the liberal or neoliberal markets where trade is encouraged cross-border, and it's seen as an accretive activity, so that if everybody trades with everybody, there is a gain to be made on average across the world, is being rebuffed or pushed back by this concept mercantilism, which sees trade as a zero-sum game. So that if you don't sell, if you stop imports coming into your country, then it means that you are going to have more economic growth in your own country, and that'll be the loss of the person who would be trying to export to you. So trade seen as a zero-sum game is a very different concept from the world of globalization that we became used to from 1980 onwards, where trade was definitely seen as a benefit globally. The features of mercantilism are tariff raising, which President Trump is talking about. The withdrawal of the UK from the European Union is another example where almost certainly there'll be some tariffs that are imposed that weren't there before. There is usually a request to limit immigration, to reduce competing labour supply so that local labour gets better rewarded and is more protected. And there is a natural reduction in multilateral trade. There are trade agreements between countries, but there aren't multilateral agreements. So Britain negotiates with the US rather than the EU negotiating with NAFTA. The key implication for real estate markets is the question that we have to face, and that is whether we've come to the end of a period where we had rising cross-border real estate transactions. And we've got used to this over the last 20 odd years, where lots of Asian money coming into Europe, American money coming into Europe. The two biggest recipients of capital investment have been New York and London, with Paris coming behind. Recently, interestingly, Paris has taken some of the share from London. So the first signs of the impact of Brexit and political change on real estate transactions have been seen recently. And what we have to ask is whether the nature of cross-border real estate transactions will change. The obvious solution or conclusion is that there will be less trading across border, but that might be limited to the major nations. It may be that the perverse result of this is that we see more money going to emerging markets, which are less affected by these new tariff barriers that are being imposed. So it's something of an open question. Cross-border real estate transactions are going to be challenged. We need to watch over the next 12 to 24 months to see whether that slows down.
Thank you.
So the picture that Hiram painted was that in the 50s and 60s we had society as the dominant driving force of a nation where reasonably left-wing politics would have looked after society through welfare programs, national health services and so on, and markets were subservient to society. And the concept post-Reagan and Thatcher, the neoliberal markets, is that the markets started to dominate society, and we've seen a reaction to that, where populism is pushing back against that, and we think that there is some sort of reaction against the dominance of markets, particularly given 2007 and 2008 and the crashes. And it's interesting that this sort of populism has risen rather than overt socialism, because given 2007, 2008, it would have been perfectly natural to see left-wing revolutions pushing back against the bankers and the fund managers, but instead we've got this populism which has said we're going to have fewer trade barriers. So globalism was seen as one of the ingredients into this loss of control over markets, and I think there's a desire to take back that control. So we need to watch whether that leads to a reduction in cross-border real estate trading. Demographics were also fully dealt with in this programme, and we have in Oxford, we have a professor of gerontology, Sarah Harper, who's done some incredible work on demographics, and some of the statistics are stark. The number of people aged over 100 years old in the UK will be a surprising, very surprising number in 10 to 15 years' time. And planning for a rapidly ageing population is an issue that's going to have to be dealt with in the US, the UK, Italy, Russia, many countries. Yolanda's point was that the demographic bulge in the ageing population will lead to a split between the older people who will be pushed out of cities and younger people who will just continue to migrate to cities. And the impact of tech and the millennial generation will be that the city will spread. And so if I look at my own children, they are prepared to take all sorts of, make all sorts of sacrifices to live in London. They will occupy smaller properties. They will live in areas that we would have said were marginal, and they'll do that in order to be part of this community of co-working, co-living that's going on in this urban environment. And that's a concept which we expect to see more and more. And when I talk about the technology change, that's one of the conclusions we'll come to, that the nature and the shape of cities will start to shift, as it already has started. One of the other implications of the demographic change is that we need to think about how we cater for, house and look after older people. Retirement ages may well push out beyond 65 in the UK to 75, but we will have a huge number of people aged between 75 and 100 years old, and we have to think about how those people get cared for and where they live. And it's very, very clear that we don't have the solution to senior housing. We just don't know. We don't have the model that works. And one of the projects that we need to think about is how we finance senior housing. So that there are three of us sitting in this room at the moment, all under the age of 60, some of them under the age of 50, maybe even 40. And maybe they should be thinking about saving now for their senior housing. And the pension entitlement should probably look after you in terms of your housing and your care, and we don't really think about it very well. So the real estate market has a job to do in providing senior housing in a financial model which works for people, and we certainly are nowhere near that yet. Yolanda's model of the 5 ages of cities, the agrarian communities when we lived in villages, largely farming. Then as the Industrial Revolution took off in the 19th century, we moved to the city and we got involved in manufacturing. And then as the cities grew and markets became dominant, we moved out to the suburbs. As the capital era took off, which is the last 25 years, we've seen millennials and baby boomers returning to the city. Generation X and Y, moving to the city in order to take part in this urban growth. And then Yolanda's concept is that the final stage of this is the expanding city and people moving to the edge of the city in order just to cling on to this rapidly rising urban environment. And we're going to make all sorts of compromises in order to live in cities. The technology issue, which was dealt with in the conference in passing in several panels, and we had one particular panel where we had younger people passionately talking about tech as the future of real estate, and we had a couple of older people who were pushing back, saying that tech is not the solution to trading this lumpy, old-fashioned, slow-moving asset class, which will always be lumpy and slow-moving. And that seems to be the big question about tech, and that's what we're going to talk about in the next 10 minutes. So, using highfalutin academic concepts here, we talk about endogenous prop tech. So, endogenous prop tech is technology that's being created within and by the real estate sector for the real estate sector. And our work has uncovered four movements here. One is construction technology, which I'm going to put to one side. There is a technology movement which is about project management, architecture, engineering, basically monitoring projects through the sharing of information by all professionals involved in a scheme. Putting that to one side, the three main prop tech verticals, as I call them, or industry groups, are real estate FinTech. We've had a FinTech movement going on for the last 10 years, which has raised huge amounts of money. The VC sector is raising about $12 billion a quarter, and a lot of that money is going into FinTech. So FinTech is online banking, applying for mortgages online, and so on. There's a real estate FinTech movement which is coming behind that movement, which is about trading houses online, crowdsourcing equity, crowdsourcing debt for real estate transactions, mortgage provision, and so on. And that is the most active of the real estate tech sectors at the moment. There's also clearly a movement, a shared economy movement, which is characterized best by Airbnb, a way of making the most of space and making the space usage more efficient. So we've seen Airbnb, we then see WeWork, a co-working proposition, and we've seen the shared economy get applied to all sorts of stuff, like parking spaces on people's front drives to sharing space in their garages, in their garage lofts. So storage, shared economy, car parking, co-working, co-living, and so on. Then the third area, which is slightly different, is the smart building movement, which has two characteristics. One is the use of technology to control and operate buildings, so that when we're driving down the motorway, we can use our phone to switch on our heating before we get home. That's clearly already in train, but extrapolating that out, you get data being exchanged between the building and the user, so that the building starts to become more intelligent. It might know when to switch the heating on without you having to do it. And the Internet of Things is part of that smart building movement. Then on the other side, we have a whole new property type which is being built on technology. So power generation buildings, and in particular data storage centers. The big five companies in the US, Google, Facebook, Amazon, Apple, and Microsoft, all of them are in the data storage game, in the cloud game. And their appetite for buildings which house data processing facilities is almost infinite. So that, for example, one lady loaded up 1 million photographs on Facebook in 1 week. Facebook will say that they won't stop her doing that. It's her right to do that. When that lady dies, her children have to work out whether they want to kill those photographs or leave them online. And Facebook, again, will leave them online if there's no request to kill them. So the demand for storage is just increasing geometrically. And Facebook is building 1 million square foot data centers at the moment in Copenhagen and in Ireland, and it's looking for 8 more across Europe. And they are the smallest of the big five players. Amazon, the market leader, is already building huge amounts of space, $1 billion facilities. So that's a whole new property type which didn't exist 10 years ago. How do these technology industry types work? Well, first of all, they work through providing information. That's the lowest level of a prop tech offering, just providing information about markets. Then effecting transactions. So PayPal is a FinTech transaction portal. Big question, will you be able to, first of all, get a load of information about all the houses for sale in the area that you're looking for a house in, and then secondly, would you be able to actually transact online? And the big question then is, clearly you can get information online, that's already happened. Will we go to the next stage where you can actually buy the house, transact without paper, online? and there's a lot of investment going into that area. And then finally, the management of space, the shared economy and the smart building movements are both about the management of space through technology. More exciting, maybe, is the whole concept of exogenous tech, which is technology which is being developed outside and not for the real estate industry, but will have a huge impact upon it. So that the driverless car, the use of drones, artificial intelligence, they'll have impacts on the shape of cities, the way in which cities work, and on the use of property types. So will the office building become partly redundant because there will be fewer workers in office jobs because of AI and robotics, which will perform the functions of the office worker? An open question, but that's going to affect, it's already affected retailing. I mean, the whole concept of Amazon, which is not a real estate business, has already changed the shape of retailing through click and collect and so on. The office movement is changing. The way the office market is working is changing through working from home and so on, and it may well be changing more through AI. The logistics market is changing because of distribution of goods through online retailing and so on and so on. And we're developing co-working, co-living space and so on. So the nature of real estate types are changing both through endogenous tech and through exogenous tech. And here's our picture of this. There's a big FinTech sector, and there's a growing PropTech sector. The overlap is real estate FinTech, which is big question, will you buy your house online? The smart building movement is partly driven by construction technology, but it's largely a PropTech sector. And then the shared economy, which applies outside real estate. So Uber is a shared economy proposition, nothing to do with real estate, but there's a large part of shared economy businesses which are property businesses, Airbnb and so on. They're the three verticals: real estate, fintech, shared economy, smart buildings, and the horizontals, the information provision, which is working across all of those property types, and then the transactional marketplace, which is clearly being developed within real estate fintech and also in the shared economy, so that you can go online, you can find an empty office space that you can lease for 2 weeks, and that's facilitated as a transaction tech platform in the shared economy space. And then the smart building movement is largely about management and control of buildings, and not about transactions. The majority of the activities you can see is in the real estate fintech sector, and something like 38% of all of these startup applications that went to one particular accelerator were in the real estate fintech transaction space. So that's where you can expect to see a lot of money made and a lot of money lost, and open question, significant change in the way we trade and buy real estate, and that's the pressure point. That's where the money's going, and that's where the excitement is, and it's probably where the biggest problems lie. We have all sorts of prop tech businesses that are emerging. Some of these businesses are connected with the business school at Oxford. It's almost as if every MBA student needs to have a tech business up his sleeve on the side as something he's working on, and several of our students seem to be involved in these businesses. This is the second wave of prop tech. The first wave of prop tech in 1995 to 2005 created things like in the UK, Rightmove, in the US, Trulia and Zillow, in the commercial property space, CoStar. Lots of consolidation, lots of businesses in the dot-com bust in 2000, lots of businesses going out of business, or being acquired at low prices by the survivors. And the survivors then built market share and developed reasonably unsatisfactory propositions, it has to be said. That, they weren't using the best engines. 2008, 2018, a new wave of technology is now available, better technology, and a new burst of tech businesses, literally hundreds and thousands of tech businesses, which are using better technology. And we know what's going to happen next. There will be more failures, more consolidation, more survivors. And then the big question is PropTech 3.0, which is probably going to be driven by the concept of blockchain. And this is the potential solution to the trading of property online. So if the big question is, will I buy my house online, then the answer to that question is probably, if blockchain works, then you will probably trade houses online. And blockchain is a way of exchanging data between two people without a middleman, through secure codes. that will enable the two parties to trust each other, so that I would give all my documentation about my property to Steve through a coded transfer of information, a distributed ledger it's called, and Steve would send his money to my bank account in return, and that would be the transfer of title, and that would be the buying the house online. So the concept of blockchain is the big question that needs to be thought about, and maybe we'll develop a whole property currency called PropCoin. So the three big movements then: smart buildings, that's an irreversible movement. It's driven by energy efficiency, by sustainability, by making sure that we use our buildings in a responsible way, not leaving the heating on all day. The shared economy could be a fad. There is something very millennial about the shared economy. A 25-year-old who hasn't got any money can be forgiven for thinking that the shared economy is the right way to be. But I remember when I was 25, I was thinking of living in a commune. When I'm 35 with 3 kids, I'm not thinking about living in a commune anymore, and I do wonder whether the millennial generation will be thinking about the shared economy when they've got some money and their own capital. So slightly dubious about the shared economy as a big movement. But then the big question, real estate, FinTech, there will be a few big winners. If somebody does crack the code on how to trade property online, there will be some enormous businesses. And one of the fascinating statistics is we think about 5 to 10% of the VC money is going into real estate tech, and yet real estate is about 50% of the world's assets. So why is there such a small amount of money going into real estate tech? The answer to that is because real estate has no velocity. There is no transaction turnover. So whereas Amazon might turn its stock over 15 times in a year and therefore create massive trading, the real estate market, a typical commercial property, will sell once every 6 years. So there just isn't the transactional volume that will fund all these people investing in tech. Now, if the tech does create velocity, in other words, if we can trade property online very quickly, then we will have this virtuous circle whereby there'll be more and more investment in making that work. So it'll be very interesting to watch and see whether technology helps us to trade in and out of real estate more quickly. Of course, property taxation will be a barrier to that, but it'll be very interesting to see how that develops. And then finally, the headlines from our report, which is still being put together, so these headlines might change a little bit, is, first of all, we see the vertical city getting closer and closer to us. And there are already cities like this. Hong Kong is pretty much a vertical city now. And I remember working and living in Hong Kong for 5 weeks when I was working there. I was living above the hotel where I got my food, which was above the gym where I kept fit, and that was above the supermarket where I bought stuff, and I was simply travelling up and down. And I think the modern city of 2050 will be tall and vertical, and people will be travelling up and down this space. There'll be co-working space, there'll be co-living space, there'll be retail space, there will be drone deliveries to the rooftop. The building will operate in this vertical way, and the lateral travel will be expensive and challenging. And we're already in a world where people will not travel laterally more than 20 minutes in London. They would rather travel up and down the building. So that is getting closer and closer to us. And that might be matched by an agrarian movement of new hippies living in the countryside, or second homers in tiny homes. So you'll have a tiny vertical home in the city and a tiny rural home somewhere in the sticks. We will probably trade houses online. Now, it's a big question about whether blockchain really works and whether the tech investment will bear fruit. But there is such a lot of activity in this area, and such a great demand for it, that it's almost certain that at some point we'll trade houses online. How many barriers there are to that, how much paper there will be behind it is unknown. But there is a tremendous momentum towards that outturn. Smart buildings and new property formats are guaranteed to develop. Buildings have to become intelligent. The limits on energy use means that we have to be intelligent about how we share data about energy use. And property formats like data centers are driven by power. They're driven by energy use. How do you limit the amount of heating that's generated from a 1 million square foot building with huge numbers of terminals, of data processing terminals in it? Should that building be somewhere cold, and can you capture that heat to heat houses? In the commercial property market, in the investment and fund management market, we are going to see activity which is addressed towards crowdfunding on online secondary markets, so that we should be able to go online, buy 1% of the NatWest Tower in London or the Empire State Building and sell our unit in that building in 5 years' time to somebody at hopefully a higher price. Much activity in that area, but having said that, the amount of activity that's in that area is probably not going to pay off to the level that it expects to. So my conclusion is that's not going to be it's not going to be easy to create that market, because people don't have enough information. There will be some scandals, there will be a lack of investor protection, there will be a withdrawal of activity, and therefore there will be a lot of disappointed people in that market. So there may be some trading online of buildings, but it'll be limited. There's one particular aspect of defined contribution pensions, which means that investors might need daily pricing, and therefore listed properties traded through a single asset property company on platforms like IPSX, which is just being developed, may go some way to this, but it's going to be a limited market. The shared economy I've already explained is, I think, in part a temporary fad. I think co-working is here to stay, but I suspect the co-living part isn't. And inevitably we're going to get a backlash. There's going to be a big regulatory and human pushback. Airbnb is already suffering pushback. There will be accidents, there will be trashing of houses, there will be a reaction against Airbnb. There is now a reaction against Uber that's going on, and the world isn't quite ready for all of this shared economy stuff and shared space, so there will be pushback. And human beings at the moment cannot be replaced by AI or robotics. If you're trading a £500 million office building in New York, you need professional advice, you need lawyers, and you need property experts, and an online tech platform is not going to be your solution, if only because if anything goes wrong, you want somebody to go back to. So, partly positive, partly optimistic, and partly guarded in our conclusions about what is happening. A lot of money is going to be lost, and a small amount of money, or a large amount of money, is going to be made by a small amount of people.